Okay, hello everybody. September 9th, 2022. It's 4:15 p.m. Thanks very much for joining me today. By myself today. Scott had some client work out of the office he needs to take care of. So just doing a slightly different format today. I thought I'd put up a couple of talking points that we're going to cover just with the presentation there, and then have a number of slides to go through. Um, Back to work, back to September. Lots of action this week from a market perspective, central banks, jobs, kids back to school, lots of things to cover. So thanks very much for joining me today. As I mentioned on the call that we had last week, one of the things that I intended to try to pay attention to this week is just what was going to happen, what the follow through is going to be like. We had some up markets into the close last week, and I said, we may see something different this week. And so Monday was a holiday. Come into Tuesday now, and we've had a fair amount of data specifically for Canada. The Bank of Canada raised rates 75 basis points. So, I've been talking about this for most of the year, and have had and continue to have a ton of questions around where the top is in interest rates. So we're going to talk about that. We also had the ECB come out with a 75 basis point increase as well yesterday, and we had Canadian job numbers. So I'm going to comment on that and just provide an update for what's changed, what hasn't, and where we are from here. So the first topic I just touch on is what happened in the economy. So I think probably the biggest thing from a Canadian perspective, what happened in the economy is that we had the jobs numbers come in today, and I'll touch on kind of the breakdown of that jobs numbers, but it's 3 months in a row of falling numbers. The consensus was a 15,000 job add for last month, and we came in with a 50,000 job loss. So big miss based on the jobs numbers. Rosenberg put out a couple comments today based on it, and essentially said, yeah, I think the central bank this week in their comments were being overly aggressive and saying we're going to keep our foot on the gas because the economy is in such great shape. So he certainly throws into question that he thinks that they're trying to talk a big game, but ultimately, as the data continues to come in, they'll have to make an adjustment based on that. So that biggest thing in the economy for Canada. And then, as I mentioned, with the ECB raising rates 75 basis points, on the outside looking in, that sounds like a severely tighter financial conditions. But as I referenced a little bit in my daily today, was that they have done this, which is higher rates. But one of the things that they came out with in 2020 was this. I think it's a TLTRO, one of the initiatives that they came to help stimulate and support the European economy and support the commercial banks. So they had put loans in place, which essentially gave them free money, and then they could loan that money out and hopefully make some money from it, but ultimately was stimulate the economy. So what the ECB said is we'll continue to allow you to have this money. We're not calling it back in, which it was supposed to be this year. And as given the European banks, somewhere in the neighborhood of 125 or 150 basis points of essentially risk-free capital when they hold it and then they loan out against that. So that's interesting, worth paying attention to. Obviously, they're trying to do both, which is trying to tighten the rates, financial conditions, but also easing over here. So I'm not sure how much that's going to help the consumer side that they've been trying to support there. And so what happened to the markets? Well, we had a choppy week this week, and we've had volumes down quite a bit year over year, which I don't think I put into the daily today, but year over year numbers were as of last week, we're looking at something in the neighborhood of 33% lower volume so far. So that is something that I think we need to pay attention to. So that's happened in the markets, and stocks and bonds seem like they're starting to move in unison again. So what as well I'll need to pay attention to as we go from here. So I'll touch a little bit more on that, and then at the end I'll come back to this, which is what are kind of the questions that we covered or clients had this week. So here's the handful of things that caught my attention this week. And as we went into the close yesterday, we had stocks down and we had volatility down. Then the inverse today, what we saw is we had stocks up and we had volatility up and we had volumes down. So these are some interesting dynamics to think about. Have we already bottomed in stocks? And are we starting to see kind of just an adjustment to that with ultimately higher prices from here to the end of the year, or is something else happening? And so a lot of changes going on underlying in the market. And so those are some strange events that we saw here. The other one, which many people probably follow on a high level, is just the correlation. So, the correlation with the US dollar versus other things. And for the last 90 days, the last quarter, we've had massive inverse correlation to that. So whether it be oil or S&P 500 or Canadian dollar or Japanese yen, you get an inverse correlation to those two things moving. And so the higher that number becomes, really shows you kind of the strain that there is in the financial system. And so that I would continue to watch and see if there's a divergence from that trend. The other pieces of data that I look at is what's the CFTC, which is the non-commercial hedgers, like what's happening in the futures market. And so a couple of material callouts that I'd look at is you had big short interest and volatility. So you may remember this event a couple of years ago where lots of hedge funds institutions were shorting volatility to pick up some income, and we're starting to see that happen again as the markets have recovered here. So that's worth watching and paying attention to. You get long institutional interest again on the NASDAQ, and so futures contracts owning the NASDAQ. So that's interesting, which gives me some concern about the growth rolling over short term. We have max short-term positions on 10 years, 5 years, 2 years in the US, which means that there's a lot of people out there shorting the bond market in the US and in Canada. And so you've seen some upward pressure on prices. But ultimately, I still think that's holding a beach ball underwater. At some point, you get yields dramatically falling and prices rising. But right now, these are some callouts that I'd look at. The other area, which is precious metals that continue to follow, is that it was a max short position in silver as well coming into yesterday, I believe. And we also had a minimum crude long exposure year to date. So that's an interesting point from the perspective that we've had a couple of weeks of correction of oil, pretty material sell-off, but it looks like that's overdone, at least for the short term. So some of that information will come out in the CPI numbers in the next little while. But I think we've seen kind of a near-term bottom in oil, temporary, but presently where we are today. Okay, so I'll just take through a couple of slides now around what's happening in the greater economy. So as we look at the mortgage data, which is important to both Canada and the US, this is US data that I have because it's more recent, but similar things would apply in Canada as well. And so one of the most important things of note is, mortgage applications in the US have fallen off a cliff, as you know. If you look at the data there, we've approached essentially the same levels of April 2020. And so that was the worst possible time of the COVID time. So mortgage applications have gone dramatically back down to the other side of this. And I don't think this is completely done with the current place we are, but we've seen a massive slowdown. And of course, in turn, you see mortgage purchase applications slowing on a sequential basis. So it's certainly important to pay attention to what do we do now, and what's going to happen to the housing market in Canada and the US. And so this was interesting data, more on the Canadian housing market as we saw rates come up significantly. And I've been talking a little bit, had lots of questions about mortgages, but all of the institutions do things a little bit differently. One of the reasons this rate increase is relevant in Canada is that some of the major banks lend their variable rate mortgage where it's a fixed payment. And so as rates go down, you pay more of your principal if your payment's fixed. But if rates go up, you pay more of your interest. And so what has been transpiring in these last couple of rate increases is we've seen some people's mortgages that have fixed payments, their amortizations moved out to 40, 50, 60 years. And now with this increase, this actually could potentially trigger them to go back to their clients that have mortgages and say, we need a top up on that, which could be, $5, $10, $15,000, or we're going to add that back onto the other end of your current mortgage. So a lot of things happening within the Canadian variable rate mortgage market right now. National Bank, just for information's sake, they don't do that type of fixed payment where if you have a variable rate and they rise, your payments rise in turn with it. And so that keeps your amortization fixed. But a lot of things happening there. I'll cover more of it as we go, but just want to comment on a little bit to do with the Canadian US mortgage market. So the other piece, and I've talked about where I think we're presently in the middle of a recession, and this is an interesting look at just what's happening around the world. And so one of the key triggers, historically at least, has been an inverted yield curve. And so if you look at the obviously on the left-hand part of this slide, you'll see the countries in the world that have an inverted yield curve. And what that means is that the 2-year bond rate is higher than the 10-year bond rate. And so you have an inversion. And so the central banks would control the short end of bond markets, where the economy would control the long end of the bond market. And so essentially right now, as central banks are pushing up here, and the economy and people investing in bonds are saying, well, we think long-term growth rates is slowing. And so this end is coming down right now. So historically, this has been a trigger signal that we need to pay attention to. Really wanted to point out that Canada is not alone. If you look globally, there's a number of countries, the majority of them that have this in yield curve inversion. And so as I mentioned today from the jobs numbers in Canada, so if you look at this is a Bloomberg headline. So unemployment jumps from 4.9 to 5.4% in Canada. And so that was, I think, interesting because the central banks have primarily been standing on, we have this hot employment market. This is something that further tells us that we need to stay on this tightening cycle, and as long as jobs continue to grow, then we'll continue on this path. So something to pay attention to, as that verbiage they're using is starting to not be as relevant today, and we see it in this most recent data with the jobs numbers. And so if we look at it here, this was the breakdown of where it came from. And so total miss of 40,000 jobs. So what the breakdown was full-time, part-time. 77,000 full-time jobs are lost, which is a big number, and 37.5 part-time increase. So, but if you look at the breakdown across it, the other thing that was concerning is the majority of those were high-paying jobs. And so we'll see what this means and how it plays out as we continue to watch this. But I think it's an important thing to pay attention to as we progress with the economy from where it is here. So one of the unique things that we're trying to accomplish is position for what's coming in front of us. And so as I present the data to you today, you'll see some of this is a lot of it's real time, what's happening right now. But the objective is how do we interpret that and think about what's going to happen tomorrow? And so this is an interesting chart to think about, what's ahead, primarily what's ahead for inflation. And so right now we're in a position of elevated inflation, and National Bank recently put out their inflation expectations for next year, and they're calling for inflation on an annualized basis to be somewhere around 2.5%. But this was a piece showing essentially the path we're on based on the historical setups that we have right now, is that we could potentially see true deflation in 2024. And so it's interesting to think about, there's this upward sloping. We think rates are going to go up forever, and that's how the media is promoting it. But the likelihood is rates have gone so aggressively, the economy's tightened so aggressively, particularly in Canada and the US, that we don't continue on in one direction forever. In order to get inflation under control, it's starting to come down already. It's starting to accelerate to the downside, and these further tightenings will increasingly put pressure on the consumer. So just taking this into context about what's in front of us, I think we're getting closer and closer to excuse me, the end of this runaway inflation that we've seen over the last 12 to 14 months. So the last piece I'll put on asset allocation, then I'll go back to the first slide just about some of the questions that we had this week was, this is a view at stocks and bonds since 1950. And so why it's relevant is, we're sitting out here the first half of 2022 in probably the worst setup that we've seen in 70 years. So the interesting thing is thinking about, from a positioning perspective, what do we do from here? And so in the daily, I put some comments about bonds and when we've had these similar setups, and I think we're approaching that event as well, where we could see that positive outcome where they start to move in tandem together, and we see this start to move out here into the the higher return risk profile that we haven't seen, where we get pickup of the two of them together again. So it's important just to take into context for where we are and portfolio positioning. And so the last section, unless anyone has any questions, is I'll just comment on what's coming in and what we're being asked recently. So continuing to spend time with people talking about either their estate plan or where they're going. I've had a few clients in the last month and a half or so ask about trusts. Specifically, some have been asking about Henson trusts. And so we've been working through how best to position that, what we should do, and trying to understand the intricacies of this. So if this is relevant to you, certainly let me know. We can talk about that. On the estate planning side of things, it's more around the question of what does it look like? What does the estate picture look like? How do I plan? If I want to give to charities, how should I do that? So been spending a fair amount of time with individuals on planning with that. So if you have questions around that, let me know. Continued questions about trustees and power of attorneys. The rules around those continue to change. So if anyone has questions, we've been trying to address that here. And the other one is we've seen the US dollar gain strength this last year. Continue to have questions about when's the best time to either convert some US dollars back to CAD or CAD to US dollars, as well as the euro and sterling. So if you have specific questions about individual countries, let me know. But with my view that we're in a recession and that I think things continue to slow, is that the likely outcome is US dollar goes higher short term versus CAD. And so I'd be staying with that position because that's, I think, a safe place to be, in a good place to make some money over the next 3 to 6 months. And so I'd continue to have that view that I think that's the appropriate positioning for right now. However, as we get ongoing closer and closer to what I think is the end of this kind of risk-off environment that we've been in for the last, I'd say, 7-8 months, we're starting to look at the very big variances. And I may mention a couple of weeks ago, as you look at the NASDAQ, we're 2 standard deviations below its long-term average. These have historically been trigger points. So as I continue to look and patient on what to do, I think growth is starting to look increasingly attractive, but didn't make changes, being patient and looking at it one day at a time. So if nobody has any questions, looks like it was a beautiful week this week. Looks like we're gonna have a great weekend. So I hope everyone enjoys their weekend, and we'll pick this up next week. So thanks everyone for joining me, and have a great weekend. Take care.